Okay. I'm sorry, actually, about a little confusion. I actually was wondering why no one was in class today, and was fearful it was a holiday today, because I actually went in the wrong room. Okay, this room looks like the same as the other rooms, and so I carefully set up there, and was wondering why nobody else was coming to class. And then it dawned on me, you guys have some Mid-Autumn Festival, but that's not. When is the Mid-Autumn Festival school week? That's what?
This Monday.
Monday. So school is scheduled on Monday, but not Tuesday.
There's no school on Monday.
No school on Monday.
But unfortunately, you do have to teach Tuesday morning.
I have to teach Tuesday morning. That's the important point. So I didn't miss anything, and everybody is here, and that's the way it's supposed to be. Okay. Any questions to start us off here, logistically or anything like that? Okay. So last class we started talking about. We were talking about pricing. Basically, we've been talking about pricing forward contracts. Okay, and these forward contracts have the interesting property, okay, that somehow that when you sign this contract, the value of the contract seems to depend, the forward contract for a share of Microsoft, which is what we were looking at last time as an example, depended only upon the price of it depended only upon the current price, okay, the spot price, and the interest rate at which everybody could borrow money at, the risk-free rate. Because if it didn't, there was a way to make a profit from that. Okay? And by our arbitrage arguments, we argue that that can't be done. There are a bunch of assets that can, sort of contracts that can be priced in similar ways. And one of the, an interesting one has to do with foreign currency contracts. Okay? Just want to go through this one quickly. Suppose that every country has a interest rate in its own currency. There's a particular country, F. It has a risk-free interest rate in its own currency of R of F. Okay? There's also United States dollars. Okay? Dollars also have a risk-free interest rate. Okay? And depending upon what currencies are, different countries have different currencies. Okay? To hold one kind of currency, you might demand a higher interest rate than another, perhaps because it's riskier. The classic example these days is Zimbabwean dollars. Does anyone follow the fate of the country Zimbabwe? Who will know what I mean by Zimbabwe? Raise your hands if you know Zimbabwe. Okay? I have heard that in Zimbabwe, the inflation rate is something like 40,000% a year. Okay, some ungodly amount of money, some ungodly rate. That in the course of, walking to the store, the price will have doubled. Okay, so if you want to say, I want to put Zimbabwean dollars in a bank, you will demand a high interest rate in Zimbabwean dollars. Is that clear? Okay. Whereas for some other currency that is more stable, what are the interest rates here, let's say, which are tied to the US dollar, okay, are on the order of, I don't know, 3%, 4%, something in that range, right? You could imagine a world where you might want to come up with a contract where country F may be Zimbabwe, okay? And there is a risk-free interest rate in Zimbabwe, okay? We might want to sign a forward contract to convert a certain number of dollars into Zimbabwean money, okay, a year from now. What should be the agreed-on price for this thing? Okay, that's what the idea of the forward contract is. We're trying to sign a contract now so I can guarantee the conversion rate, okay, for Zimbabwean dollars a year from now, okay? And the interesting thing is this is going to depend only upon the relative interest rates. Okay, so let's let S0 be the spot price in dollars of 1 unit of Zimbabwean money. Okay? So maybe for 1 unit of Zimbabwean money, today is half a dollar. If there's such inflation, the next day it'll be $0.25 and stuff like that. Okay? F0 is the future price in dollars of 1 unit of Zimbabwean money. The claim is that the the forward price, okay, of the right forward price for converting 1 unit of Zimbabwean money is the spot price raised to the difference in the interest rates, okay, times the period of time that we're having this. Okay? That's what the claim would be. And so that the right, let's say, conversion rate of these things, the future currency prices, is purely a function of what the interest rates are. Okay? Why isn't it the case if everyone knows that Zimbabwe is suddenly going to get healthy? Okay? That Zimbabwe is suddenly going to become a great country. If everybody knew that, okay? Why wouldn't that be factored into this equation? Okay? If everybody knew there was going to be a change in this period of time, why would we argue that that will not be factored into this equation? It would be in the interest rate or the spot rate somehow. If everybody knew that Zimbabwean money is suddenly going to become stable in a few months, right? Suddenly I'd be a lot happier to hold Zimbabwean money than before, right? And the conversion rate is going to change. The interesting argument here is, again, that these conversion rates are purely a function of relative interest rates. And let's make this, I think it's easiest to see in this kind of a figure that if we have a forward contract for converting money, okay, from one rate to another, suppose, let's say, right now we own a certain amount of foreign currency, okay? If we have the ability to get into a forward contract to convert that currency to dollars, okay, I claim that there are two different paths by which we can get a fixed amount of dollars, okay, a year from now. If we want dollars a year from now, and we have a foreign currency now, one thing we could do is immediately convert it at the spot price. Does everybody agree with that? We take our current dollar, a yen, and convert them to dollars. Okay? And if we convert them to dollars and we now put them in the bank, what will we have at the end of that year? We will have the conversion price, the $1,000, multiplied by the 1,000 yen, multiplied by the current conversion rate to convert it to dollars. Does that make sense? And we now put it in the bank, okay, and we would have, at that point, okay, because of interest in the dollar interest rate, we will have that raised to the dollar interest rate. Is that clear? That is one way to take dollars now, yen now, and have dollars a year from now. Any questions about that? Like I didn't understand what you said. Okay? But there's another way I can get dollars from now. If you are offering me a contract now with a guarantee of what the exchange rate will be a year from now, okay, to convert yen to dollars, I could instead keep my money in yen for the next year, okay, and and let it earn interest in the yen place. Does everybody see that? And then, because I have already locked in a conversion rate on this money because of the forward contract I've done, okay, I could then convert it a year from now, okay, and be sure I will have the right amount, I will be able to have that amount of money, okay? So the other path that I could do is to keep my money in yen, earn the interest rate on yen, which is going to be, based on the, basically raise it to the interest rate times the time in that foreign currency, and then apply the forward rate based on the contract that I can get into now. Does everybody agree that if I can sign a contract for a future exchange rate, I can do this kind of deal and also guarantee me, basically obtain this many dollars, okay, take my original stake The contract was presumably a fair thing we were signing. It was between me and you. I didn't pay for it. Okay? These are two different things I can do with my money. Okay? Now, the interest rates are outside my control. Okay? The amount of money I start with is in some sense outside, that's fixed. The only thing that is different here is the price of the forward contract. In principle, if I start from this and end up with, I have two different paths to it. If the forward contract is fairly priced, this amount of money here should be equal to that amount of money there. Does everybody see that? I'm striking a deal with you for a forward contract. What I win on it, you lose on it, right? The opportunity for mischief or profit would be if the amount of money that I got through this branch, taking advantage of that forward contract, was different than the other one. Does that make sense? So if you believe that, that then tells you that somehow the price of the forward contract should be such that the stuff on the left is equal to the stuff on the right. Does that make sense?
Yes. Confused about the definition of price here.
Right.
Because there are two things going on. One is F0 seems to be the conversion rate that you will have a year from now.
Right.
The way this is defined. There's also the price of buying that conversion rate.
Well, in a forward contract, presumably we are now agreeing on a conversion rate now, okay, for...
So it's built in.
So basically what is the forward contract? Okay? The forward contract is an agreement we are making for you to change yen to dollars or dollars to yen at a particular price a year from now. That is the security that I want to lock in. I am afraid of fluctuations here, right? I want to mitigate my risk, okay, about changes in currency here, right? So one way that I can sort of take that off the table is if I could make a deal now for what the exchange rate will be a year from now. That is what a forward contract on an exchange rate would be, right? And the argument here would be that if we agree, we're now going to figure out what is the right forward price to agree on. Okay? The argument would be that once we have one of these contracts, okay, if we look at it a year from now, okay, once I know that there is an agreement for which I can buy this contract, there is a year from now two different paths, things that I can do with my money. Okay, two different paths my money can take. Okay? And that I will start out with currency now in foreign currency and end up with dollars. Okay? If the forward rate, the future rate is properly set, the amount of money I should have, be sure of myself a year from now from either of these paths should be the same. That is what the argument, that is what the claim is. Okay? Any questions? A question like, I don't understand it, and try again would be a good question. Okay? Yes?
There are many options for the better part of the question. For example, you can first convert it to US dollars, then use time.
Put it to US dollars and put it in the bank is on the right option.
Yes.
That's one way thing I could do now. Okay? The option on the left is I have somebody willing to sign a forward contract to guarantee me a rate a year from now. Right? If so, then I could sign the contract and get this, where I keep my money in the foreign country, in the foreign currency, and then convert it at the last minute using this guaranteed exchange rate in the future. Okay? If somebody is willing to sign that, give me that forward contract, I have this choice of doing it. Okay? And if you now want to think, what is the right price for that forward contract? It should be when both of these things are better, are equal, right? It's a perfectly reasonable thing for someone to want to do, to take their money and convert it into another exchange, convert it into dollars and put it in a bank, right? If by taking advantage of the forward rate you're signing to me, I can guarantee that I will have more dollars than that, okay, a year from now. That means you're giving me a bad rate, right? You're giving me a way to guarantee more money.
But the question is, how can you guarantee that you give me a best?
We are going to right now, a forward contract, remember, was something that had a right and obligation to it, right? If I sign a contract with you saying you will give me an exchange rate to convert this much dollars to this much yen, or this much yen to this much dollars, at this rate 1 year from now, I have a guarantee that I can do this a year from now. And I have to do it a year from now, right? Because it was a contract. We both agreed to do it, right? Now, if I could end up with more dollars by taking that side of the contract than I could by leaving things in the bank, I have a risk-free way to make more money than I should be able to make by the risk-free rate of leaving it in the bank. That would be an argument that the forward price is mispriced. Okay? That the exchange rate that you're giving me next time, if I can get more money at the end of it than I should by just doing the conversion now and putting it in, you are guaranteeing me a rate that is too generous. Does that make sense? Okay? Likewise, okay, if the dollars, if it's more valuable to, if in this case I wanted to be on the long side of the contract. I wanted to do that conversion, right? If, on the other hand, the right side number, the amount of money from putting it in the bank, is greater than somebody can get by doing the conversion, I would love to find somebody who would take the other side of that deal. Okay? If somebody is willing to buy that... Okay, in the first example, when this side was bigger, I wanted to go long on that contract. Okay? I wanted to buy that contract. Okay? To do the conversion. Because if so, then I would end up with more money on this side than the other side. If, on the other end, I could find someone to take the other side of my contract, okay, at this rate, and the right side sum was greater than the left side sum, I would be rather guarantee that guy. You said, you want this exchange rate? Sure, I'm willing to guarantee you that. Because what I'm going to be doing is giving you less money at the end than I can get by the appropriate way of putting money in the bank and stuff like that. The only way that somehow these two futures are equal, these are two risk-free ways of converting this to dollars. The only way that they can be that the forward contract can be properly priced, the forward rate can be properly set, is if this sum equals that sum. Okay? Any questions? Questions?
Is there any way that the US dollars can enter the Japanese?
What?
Is there any way that the US dollars, without being converted, can earn Japanese rate?
So the answer seems to be, so what you're saying is you would like to take US dollars and earn the Japanese rate without converting them. You're saying let's put it in Zimbabwean terms. You would like me to go say, is there a way for me to take my US dollars and earn a 40,000% return? Okay? okay, without converting them. Okay?
I'm saying just like because what you're saying here is that the two countries have kind of a different interest rate, right?
Right.
So is there any way that like the U.S. dollars can, because the assumption here seems to be that the U.S. dollars can only earn the U.S. dollar rate.
U.S. dollars earn a U.S. dollar rate.
Yeah.
Currency in another country earns a different interest rate.
They're all in percentage. I mean.
They're all in percentage. Again, I've been playing a little bit loose with the concept of interest rates because they do change. But it is clear that the interest rate you get in Zimbabwe, does everybody get this idea that the interest rate you get in Zimbabwe had better be much higher than it is for dollars, or else no one would put their money in a Zimbabwean bank. Does everybody see that that's got to be the case? Okay?
So the answer is there's no way.
So the answer is no. If you want to earn Japanese interest rates, you have to have your money in yen. Okay? If you want to earn dollar interest rates, you've got to have your money in dollars. Okay? So here are the two options again. I can either convert my money now at the current spot price into dollars and earn the dollar rate. Or if someone is going to offer me a guaranteed conversion rate, a year from now, I could keep my money in yen and convert it then and know exactly how many dollars I will have at the end, because I've been offered a guaranteed rate by signing this forward contract. Right? I have a right and obligation to do it. If the forward price is properly set, then these two arguments should be the same. Okay? Does that make sense? If not, somebody has a way to earn more than the risk-free rates. Okay? And that shouldn't be able to happen. Okay? If we assume we've got a properly efficient economy. Yes? We haven't really talked. Okay, so a forward. We haven't really talked, let's say, about futures right now. We're talking about right now. Get back to last test. We're talking about me and you signing an agreement, right? You're going to guarantee me the rate to convert money, okay? A year from now, okay? And you're going to make good on that promise, okay? If we try to figure out what that rate should be, if that rate is anything else other than that these two paths yield the same amount of money at the end, one of us has gotten a bum deal. Okay? Does that make sense? Okay? Any questions about this? If people understand the two paths, I'm very happy to keep explaining this. Okay? Do you understand the two execution paths of life? The basic argument is that if somebody is willing to buy or sell, go on either long or short on a forward contract at this rate, this guaranteed exchange rate, a year from now, okay, I have two paths of execution. I can convert now, earn interest, and have dollars. I can earn interest in the other country and convert then and have dollars. Okay? And the question is now, what is the right future rate to sign now to guarantee the conversion? It's when these two are equal. What is it when those two are equal? It's when 1,000, to make sure I get this right, F naught e to the rj t equals 1,000 S naught e to the RT, right? This cancels, F0 is equal to the current spot rate e to the difference in the interest rates to the time. Does everybody see that? This is where that formula comes from. Okay? Any questions about that?
In the PowerPoint, it says that by having the options, we can guarantee a risk-free profit. But if during the whole period, the U.S. dollars depreciates a lot.
Okay, let's think about it right now. We're right now assuming that interest rates will be constant over this time. Okay? That is somehow what we're sort of assuming in this case. Okay? So let's think what the issue is. So long as or let's even put it this way, how can we guarantee it that the interest rates are going to be the same? Remember, here, in both cases, okay, we are going to be putting money in the bank. It may be in Japan or it may be here. Does everybody agree with this? In this case, both cases, we're putting money in the bank for a year. Can you go, certainly in the United States, there are things you can go to the bank and buy a certificate of deposit. Can you go here and buy a one-year guarantee from the bank of what interest rate you will get? Yes? What do they call them here? CDs, okay? Does that mean anything? Okay? Certainly today you can go to the bank and get a guarantee from the bank that they will pay you interest, a fixed interest rate for money deposited for the year. Okay? CDs are what it's called. Bonds are the kind of things that we were talking about this being called in the real financial world. Once we buy one of those bonds, we no longer care what happens to changes in the interest rate. Does that become clear? That's the bank's problem. Okay? So yes, we have guaranteed. Okay, if we assume that these rates here are the rates that I can buy those guaranteed bonds for 1 year, which certainly I can buy in the store and go to the bank and buy. Right? If these things are mispriced, okay, if this thing is not equal to this thing, if someone's willing to sign one of these forward contracts at a price different than this, there is a way for me to earn more than that on my, risk-free, okay, by taking advantage of the conversion. Any questions about that? How many people sort of get it? Okay, how many people don't get it? Okay, anybody? Okay? Let's move on. That's basically just what I sort of said. Okay? So up till now, I've been talking basically about forward contracts. A forward contract was a deal between me and you. Okay? And as you can see, if we're going to guarantee something happening a certain amount of time from now, okay, we can come up with what the right price for these things are. Okay? So if the other party is willing to take a different price, I have a way of making a profit from it. Right? Now, forward contracts, again, were between two parties. Future contracts are things that are traded on exchanges. Okay? So, if we think about the difference between forward and future contracts, there are some technical differences, I gather, about when stuff has to be delivered. Okay? As opposed to it being delivered this minute, I think you may be able to deliver it anytime within a month. Or there's some complicated rules on the exchange governing the flexibility of when you have to actually deliver the item. Okay? But the bigger difference for us is that futures contracts can be traded. There is a market in futures contracts, and the reason that works is because instead of me and you negotiating a special rate for converting dollars to yen, you might imagine that there is a contract out for converting dollars to yen at $110 to yen. You can convert $1,000 to yen at that price a year from now. The ability to do that conversion, we've now guaranteed what it's going to be. The right to do that conversion, okay, has some value. The value of that contract is what that contract will trade at. If people think that the yen is going to go down, the fact that I have already guaranteed a conversion at a high rate makes this contract more valuable. Okay? Does everybody see that? That once we have one of these agreements, we saw that the value of whether we felt we had gotten a good or bad deal on this, the forward contract plays out in time. If we can find people to trade this with, there can be an exchange. Okay? And the only way that can work is if these contracts are standardized. Okay? So they are offered in fixed denominations. Like let's say, for example, let's think of a futures contract in corn. Okay? There might be a contract out there for selling 5,000 bushels of number 2 grade corn for delivery in July. Okay? At a price, at a particular price. Okay? Let's say there's a contract for delivering 5,000 bushels of corn. Okay, in July at, for a total cost of $1,000. Okay? The contract where you have to deliver this thing has a value, and it depends upon things like what the current price of corn is. Okay? What the interest rates are, things like this. This contract now can trade on the exchange because it's fixed. There are lots of these contracts out there. Okay? And people can buy and sell them. And there can be a market in these things. Okay? That's what the futures market is. Any questions? Okay? One of the interesting things here is that the contract has to be standardized. If I am going to sign a contract where I'm going to deliver 5,000 bushels of corn in July, I have to make sure that we have to have some kind of a definition of what it means for corn to be good, right? Should I give you rotten corn? You would not be happy with that, right? So the contract has to specify exactly what corn, the properties of the corn are that are going to be delivered in July, right? And that's why there is an agricultural definition of what number 2 corn is. Okay? It is corn that has a certain amount of moisture content, that has a certain color to it. Okay? That can be measured somehow. Okay? Has a certain weight per bushel. Okay? And once you fix these things so that it clearly is a well-defined entity, okay, then you can have these contracts and you can trade these contracts. Any questions? Now, one issue about futures contracts is that in principle, when I buy a futures contract agreeing to pay $2,000 for 5,000 bushels of number 2 corn in July, most of the time I am not going to end up wanting the corn. Okay? In principle, if I have this contract, there's got to be a farmer someplace who, if I hold on to it, will give me that corn at that time. But most of the time it is messy to deal in corn. Okay? I'm more interested in speculating here or guarding myself against changes in the price of corn. Suppose right before, somewhere along the line here, I have agreed to buy the corn. Suppose later on I buy a contract or sell a contract, okay, to sell the corn. Okay? Then I no longer have any obligation to deliver. Does this make sense? You can either buy contracts or sell contracts in the futures market. One where you're buying corn, one where you're promising to buy corn at a particular price, one where you're promising to sell corn at a particular price. So long as before the delivery date I buy offsetting contracts, I don't have to actually physically deal in the commodity. Okay? But the fact that these things do in fact relate to commodities means that the price movements will follow that. Any questions? Okay. So what would we expect? Again, if you think about these contracts, you can word the value of this contract in terms of a question of what is the price of the future price of the corn. Okay? One thing that you would think is if there is a current price for buying corn on the market, okay, what should the price of corn be a year from now, all things being equal? Should it be higher or lower? Okay? Let's think about it. Okay? In principle, if it didn't cost me anything to store corn, okay, I could buy it now, okay, and store it someplace and deliver the commodity then. Is that one possibility? So if the future price of corn is too high, one way to satisfy, to make a profit on it, let's say somebody is willing to buy corn for $1 million a year from now, and it costs $100 now. It might be in my interest to buy the corn now, borrow money, buy the corn, okay, store it, and then deliver it then. Does that make sense? So that's an argument that if I can, that somehow the future price of corn is going to be a function of the current price plus something having to do with what it can't get, the future price shouldn't get higher than the cost of buying it now and storing it. Does that make sense? And that cost is going to be the cost of borrowing money to buy it now and the cost of actually storing it. Okay? So long as there is a contract, the possibility in the contract of actually delivering the object instead of offsetting it, the price of the futures price and the current price have some relation to each other. Does that make sense? And as time goes by, when there's less uncertainty and the less time value of money, we would expect that will ultimately collide. Because if I have a future contract to buy corn at $10, and people, right now, if the future is now, and the market price is $20, it would be worth it for me to buy the future contract and take the immediate delivery. So these prices have to converge as time goes by. And the relevant differences here largely reflect the cost of borrowing money if I was going to buy it and store it, okay, and storage costs. Any questions? Okay. So the point is that with these contracts, again, anyway, I think I basically said that. I think I'm just going to move on at this point. Any questions? No, in fact, actually, I'm not happy about it. I think I'm just going to move on and talk here about options a little bit. Okay? Any questions? Yes? Okay, then I'm not going to skip. Okay? Let's go. I'm sorry, I'm getting a little Fumford here. Okay. So let's go. Okay. Sorry, let me go back here again. I'm sorry about that. Okay. So what is the idea that we were saying here? We have this world where there are futures contracts and future prices people are guaranteeing. The thing that is interesting is that the price for futures, because you can relate them to goods, okay, has some connection to, again, all these things sort of relate to what is the current price of the good and what is the interest rates, what are the profits for borrowing money, okay? If the futures price is too high, okay, it would pay for me to buy the asset now and short a futures contract. Does that make sense? Okay, shorting a future market contract means that I will sell it at the future price. If the future price is too high, okay, too close to the date, then I would be better off buying the asset now and shorting the contract, agreeing to sell it. Does that make sense? Okay? If the future price is, again, so what I'm saying, the future price is $100. Okay, and the current price is $50. Someone is willing to buy it at $100 tomorrow. If I can buy it at $50 today, okay, I'm better off buying the thing for $50 and buying the futures contract to sell it, selling the future, buying the shorting the contract, so I can sell it to the guy for $100 tomorrow. Then I could actually deliver my asset and clear a profit. Yes?
I think the spot price is so
What is the driving force, you mean?
the driving force, yes.
Well, the way I think about it is there are two different markets. Here's, I guess, one way to think about it. There are two different markets for these assets. One is, let's say, the current corn market. I don't know where you buy corn, but let's say it's a store. Okay? There is a value of a current market where you can buy corn right now for delivery instantly. Right? There is a separate market trading futures. Does that make sense? These two markets are different markets. Changes to prices in the to prices in the current market. Okay? Changes to the spot price, what you can buy it for now, will change the futures price. Because I can do this kind of game. Does that make sense? And if the futures price changes for some reason, that would also change what it is in the spot price. Suppose suddenly people are willing to buy corn for tomorrow for $1,000 a bushel. And right now it's trading in the store for $20 a bushel. What is going to happen? The store is going to run out of it very quickly at $20 a bushel. Is that right? So the price in the store is going to go up. So the thing is not that one drives the other. In fact, these are two separate markets that are tightly coupled. Okay? And that's, I think, the better way to think about it. Okay? Any questions? Okay? And again, a similar argument is that if the price stays below the stock price, the future price is too low, anybody who wants the asset in the future, okay, should basically go along on the futures contract and accept delivery. Okay? The future price, if someone will agree to sell it to me for a very low price tomorrow, if I want it tomorrow, it would be silly to buy it today. If I have it today, it would be smart for me to sell it, put it in the bank, buy one of these futures contracts, and get the delivery tomorrow. Everybody see that? So basically, these things are, there are these odd relationships that have to hold between future and current prices. Okay, because I can play these games. Any questions? And these work only, though, if we ignore the cost of storage, okay? Taking delivery on 1,000 pork bellies that have to be refrigerated. Cost storage, right? So you have to factor that into the price difference. The durability of the asset. Okay, it's not clear to me how long I can keep pork bellies in the freezer. Okay, and still sell them to somebody, that they still measure the proper specs. Right? Yeah.
Yeah, so if somebody has to deliver something to me tomorrow,
Yeah.
I will never know who is going to deliver that thing to me.
That is actually a very interesting point. In one of these markets, people are buying and selling these contracts. At the exchange, you're buying it, somehow a contract. You're not buying from a particular person. So yes, I am buying a contract where I'm guaranteeing myself delivery of 5,000 pork bellies. But I don't know from whom. Okay? Or implicitly, I do know from whom. Okay? Because this contract came from somebody, in principle, somebody had to sign this contract at the beginning. Okay? But okay, let's go back a couple of. First of all, I shouldn't have to care about whom it is. That's the first order of business. Why don't I care about whom it's coming from? Okay, so long as I get it from somebody. It's because these things are regulated by contracts and the good was specified, right? So I know that the good had to reach the quality that was guaranteed in the contract. Does that make sense? So this only works when you're trading commodities. What is a commodity? Does anyone remember what the definition of a commodity was? It was a good that was somehow interchangeable. One bushel of corn was the same as another bushel of corn. If on the other hand we're talking about a painting from an artist, okay? These are not interchangeable, right? The painting from Picasso is worth more than the painting from Skiena. Is that right? But a bushel of corn from Picasso is not worth more than a bushel of corn from Skiena. Does that make sense? So in a commodities market, okay, where it really is a commodity, in one level I don't care about it, where it comes from. The question is, how do I guarantee that in fact it's coming from somebody? Well, when we first issued the future contract, somebody bought, there was originally these futures contracts, remember, are like forward contracts, but they are traded on an exchange, right? What was a forward contract? It was a contract between two people, right? Where I agreed to buy something from you for a fixed price, right? So this contract still has the identity of who was buying and who was selling, right? But this contract is the same functionally as any other contract, okay? Does that make sense? The point is that each contract is still bound with a deliverer or a seller of the ultimate thing, okay? Because it was a forward contract at the beginning. All that needs to happen to make this work is that somehow ownership rights propagate according to who buys or sells the contract. And that I now believe is, does that answer your question? That I believe is now convincing. Okay? Any questions? These are forward contracts, so there is a buyer and a seller fixed. When you buy it, you assume certain rights or responsibilities. When you sell it, you assume you'll either lose certain rights or responsibilities. Okay? And these propagate with time. So ultimately, if I buy a future contract, okay, there will be a delivery from somebody. Okay? Any questions? Okay? But again, these things usually work out by canceling the contract, by eventually selling the contract back to the guy so he doesn't have to deliver it. Any questions? Okay. Now, one question that's kind of an interesting thing, okay, is you have this futures contract. You think about it, there's a current spot price of the thing. There is a current futures contract depending upon what the people are buying and selling futures contracts at. One thing that we might want to know is, what is the expected price of the good, actually, as a function of futures prices? Let's think about oil, right? You hear about oil futures now, okay? Can we figure out what the price of oil should be a year from now as a result of the activity in the futures market? Okay? That is kind of an interesting question, right? You hear in the news the current spot price of oil has changed. You hear that there's people who are trying to protect themselves against oil movements, like airlines, by buying futures contracts to secure oil being delivered at a fixed price a year from now. The question is, can we tell anything about what the price of oil should be a year from now? Okay? Based on activity of the futures. Okay? Does that make sense? People are now, there's now a futures price a year from now. the futures price for delivering this a year from now. But if we wanted to guess what the spot price is going to be, predict what the spot price is going to be a year from now, is it the futures price or might it be something else? Okay? Just make this a little clearer again. As time goes by, there is a spot price. That's what the spot price is, right? A year from now. Today we don't know what the spot price will be a year from now, right? But there is a futures market that is governing what people are trading at, oil at, a year from now, right? The question really is, can we make a prediction based on the current the current price for delivery then, about what that good is actually going to be selling for then? Okay? What is the relationship between what would be the expected price of the item a year from now and what it's trading for on the futures, what the futures price is now? Okay? In one sense, the futures price is supposed to capture something about what they think the price will be a year from now. Right? The futures price is governed by the trading of these futures contracts, right? The spot price ultimately a year from now is governed by the vagaries of history, right? What would we expect? We would expect that if the market is smart somehow, there should be some kind of a relationship between the futures, the price that futures are selling for now, and what the price will be a year from now. But what actually is it? Okay, do you see what the problem is? We'd like to be interesting to be able to predict what the price of oil is going to be a year from now. There is a market now for oil futures a year from now that will tell us that the futures price a year from now is $103 a barrel. Okay, let's say it's that. But what is the most likely price a year from now? Is it higher or lower than that? Okay? Do people see that that's an interesting problem? Okay? One answer to it is that has to do with, sort of given by some economists, has to do with, depends upon who is buying and selling futures contracts. What kinds of investors did we talk about? There's three kinds of investors we've talked about so far. What are they? What? Somebody with a hand. Okay? Yes?
One kind is a spectator.
A speculator. Okay? A speculator is betting on what they think they can do to make a profit, right? What are the other kinds?
Speculators. Options.
Wait. There are hedgers, arbitrageurs, and speculators, right? An arbitrager is trying to do what? Guaranteeing basically guaranteeing themselves a profit now, right? What is a hedger trying to do? Hedgers are trying to minimize their risk, okay? And they are in principle willing to pay for that, right? And a speculator is only interested in one thing: profit, okay? So if you think about it, the futures, it has the expected future price of the good. It turns out it's going to depend not only upon the futures price, but what kind of investor is buying it. Suppose you have a hedger, okay? A lot of hedgers are buying this thing. I am afraid that the price of oil is going to be too high, right? I'm willing to potentially lose some money on the deal to buy some security. Does that make sense? If a lot of hedgers are buying, then what does that mean? Okay? The hedgers want to reduce the risk, they're willing to pay for it. Okay? Speculators are only going to be getting this if they think they can make money. Okay? So the speculators, okay, are really it has to do with, in some sense, going to be the ones that are going to be governing this. Hedgers are buying because they're afraid. Okay? And speculators are buying, okay, because they are, because they see that the hedgers are being too afraid. That would be one way of arguing this. Okay? So the claim would be, let's see if we take a look at this. Hedgers are willing to pay to reduce the risk. Okay? So if the futures price is too high because hedgers are buying it, okay, we would expect that they are going to cover themselves. The expected real future price is probably lower than that. Okay? Does that, I think I've got that right. Does that make sense? Okay? If the hedgers are trying to buy insurance, okay, if someone is willing to sell them that insurance, that's only because they are overreacting. Okay? And so if a lot of hedgers are buying, the future expected price should be less than the current price. Okay? And otherwise vice versa. Any questions about that? Yes?
So expected future price is related to the interest rate like we discussed before.
Well, okay. Let's realize that these future contracts are trading, right? So there are a couple of different ways to look at it. Okay? The price of these things, if we're delivering a commodity, okay, remember that there are some constraints based on how much the price should be constrained by what is the current price and what is the storage cost and what are the interest rates. That much we agree on, right? On the other hand, there is also a supply and demand argument, right? Where if more people want to buy futures, the price should go up. Does that make sense? Let's say that for some reason I am so terrified that oil is going to go up to $200 a barrel. I want to lock in a price now, regardless of what this thing says. Does that make sense?
If future price is higher than interest rate,
If the price is too high, okay, then you're right, I can take advantage of that if I'm willing to store the oil for a year. But storing an oil for a year has costs and stuff. So what is clear is the futures price is largely constrained by the price of by interest rates and the spot price. If it got too far out of whack, it would pay to store the oil and to go buy an oil container and store it, right? But there is room to move where it doesn't get so out of whack that you want to do that, right? And then if you want to try to predict the cost of oil a year from now, okay, that would be a function of who's actually buying, okay? Again, one type of hedging of risk that I take is buying insurance, okay? I buy life insurance. I buy life insurance, okay? You can figure out what is the expected age of what I'm going to die based on what the cost of life insurance is. And that would be a prediction of when I'm going to die, right? But the truth is because I am willing to pay more for life insurance because it's minimizing my risk than the actual commodities. I'm a hedger, okay? I am actually expected to live longer than it would be by that kind of computation. Any questions? Okay. One final note on this has to do with short sales, okay? All the arbitrage arguments we do talk about being able to short sell things, okay? And certain markets allow you to short item. Certain markets don't. Okay? But in general, these arbitrage arguments work even if you can't explicitly short something. Because if it pays for you to short something, it would pay for somebody who has the item to sell it. Okay? And so the arbitrage arguments basically end up holding regardless of whether or not there are these explicit short markets. Any questions? Okay? Okay, any questions? Okay, yes.
Yeah, so this is related to something you said last week, I think. So
Yeah.
if the price of an asset is X now, and the expected value 1 year from now is, say, larger than X,
Yeah.
you mentioned that somehow the price of the asset now will increase to balance with the future expected value. Otherwise, arbitrageurs would take advantage
Right,
of that.
right.
So remember you mentioned
Yes.
that in a way the price of an asset at this moment reflects the expectations of
That is true.
everybody. So how can it be that the expected
Recognize that there is a difference here between shares of Microsoft, which are very easy and fungible, and a share of Microsoft now today is the same as a share of Microsoft a year from now, and cost me nothing to trade, to hold, and corn. Does everybody see that there is somehow a difference between pure financial objects, like money that you can deposit in a bank, and Microsoft stock or any other kind of stock, where there is not really a holding cost to it? Other kinds of commodities you trade do have holding costs on them. Does it think about it with oil, okay? An oil future a year, to deliver a share of Microsoft, hold a share of Microsoft for a year, and deliver it then, what do I have to do? Once I buy it, I have to do nothing. Does that make sense? But in order to buy oil and deliver it a year from now, this is a much more complicated thing. Does that make sense? Because I have to take delivery on it, I have to store it in the tank, I have to then be able to ship it to somebody else. So there are fuzzier costs associated with agricultural commodities and real commodities than there are on financial assets. Does that make sense?
Yeah. So if we are talking about Microsoft then?
So then we were talking about Microsoft. Here what we're talking about now are, let's say, more physical commodities. And what should be clear is that the basic theory for Microsoft holds, factoring in these other differences of cost. Does that make sense? The difference between holding oil and holding Microsoft is that you have to store it, you have to insure it, you have to ship it, right? And the cost of the transaction costs in dealing with it are much larger. Does that make sense? As the transaction costs become much larger, there is a greater room for, let's say, deviation between the theoretical price and the actual trading price at this point. Does that make sense? Because it's a lot harder for me to go about and buy oil to put in the ground for a year, okay, than it is to buy Microsoft and hold it for a year. Okay? Any questions? Okay? That's actually supposed to be convincing. So if it's not convincing, I'd like more of an argument here. Okay? Before we showed that we could make a profit, okay, purely by, if we have these interest rates and we have these things, okay, because the transaction costs were assumed to be low. When we're dealing with agricultural costs and the actual physical delivery of these things, you're getting into messier worlds. And so, in the extremes, you would expect it still to be governed by our theory. But there is some room for uncertainty about the cost of. How much does it cost to store oil for a year? Okay? And these are the kind of reasons why agricultural futures and stuff like that have a little more room, wiggle room, trading room, than you would expect with the pure financial securities. Any questions? Is that satisfying enough? Okay? Yes?
Yeah, one more question about the expected future price. So if you somehow obtain the information about who is buying or selling the future contract,
Yeah.
so you can make a profit of that. Is that right?
Well, the answer is I don't care about the identity of it.
I mean, if you know the hedger is buying it, so the expected future price you would know.
So what you would say is, now you're trying to speculate, right?
Yes.
You're saying that if I know what hedgers are doing and what hedgers are doing, I can then speculate and probably make a profit on the deal.
Yeah.
And that's certainly right. Okay? Now the bigger question is, how do you tell who's hedging and who's not? Okay? And this is now a different question. Okay? And this I don't have any clear answer for you. Right? Now if you talk up your friends and your friends are hedging, okay? Everybody around you is hedging. Maybe now as a speculator you'll say there's more money on this. But recognize the problem here is how do you identify where the money is coming from? Okay? That's why speculation is speculation. Okay? Any questions? Okay? Any other questions about futures or anything like that? I think I talked about this more than I wanted to, but I think hopefully people found it interesting. Any questions? Okay. Let's now talk about options. Okay? Because options, again, we're getting back into a financial world a little bit in general. I think it's going to be a little cleaner. Okay? But options are a financial security. They're a derivative, which give you the right to do something, but not the obligation. How does that differ from a forward contract or a future? Yes?
In futures and forward contracts, both the buyer and seller have obligations to fulfill the deal and date.
You have the right and the obligation.
Yeah.
Okay? So if it's the right, it means that if it's going to make you a profit, you certainly can do it. But if you in a forward contract, you have the obligation. So if there's a loss there, you're stuck taking it. Options are a different kind of security that have the property that give you the right to do something, but you don't have the obligation. This sounds good, right? This sound good? Okay? Call options permit you to buy an asset at a particular price at a certain time, but doesn't force you to do it. Okay? If I have an call option to buy Microsoft a year from now, okay, at $100, if the price is $125, I'm going to take advantage of that option. If I have the option to buy it at $100, from you, but the price for a trading on the market is $90, I am not going to take that option, right? Thanks, but I don't want it. Okay? A call option, if I have an option to buy an asset at a fixed price, what do I want? I want the price of that asset to go up in the intervening time, right? If I can buy it for $100, I want the price to go up above $100. That's what we mean by a call option. A put option permits me to sell something at a particular price, but does not obligate me to sell it at a particular price. Right? So if I have a put option on Microsoft at 90, I have the option to sell it at 90. So if the price of Microsoft at that time was 80, is it good to have this option to sell it at 90? Yes. Okay? If I have the option to sell it to you at $100, but I can sell it to somebody else for $110, okay? I am not going to use that option to sell it to you. I'll say, I appreciate your willingness to buy it, but I'd rather sell it to someone at the higher price, right? So a put option, if I have an option to sell it at a fixed price, I want the option to go down, okay, below it, okay? I want the price to go down, because then my put option is more valuable. Any questions? You can do all kinds, if you want something that, so owning a put option gives you a reason to want assets to go down. Trouble comes if you have a way of making assets go down. There was an interesting thing in the news the other day about a company called United Airlines. Has anyone ever heard of United Airlines? Okay? Did anyone hear what happened to them in the news? It's very interesting, a couple of days ago. There was somebody on a newspaper website put up a web link to an article about them. Put up an article to them about, that was several years old, about a time United Airlines had just gone into bankruptcy. So the article from 3 years ago said, United Airlines declared bankruptcy today. Okay, it is reorganizing. Somehow there was a mistaken link on a live newspaper to the old article. So somebody read this, opened up the link, read this, said United Airlines is declaring bankruptcy today. They immediately started selling, right? And this somehow got published onto a Bloomberg. Suddenly the rumor swept the market that United Airlines was going to go bankrupt. The price plunged, okay, lost 3/4 of its value, okay, by the time somebody figured out that this was a false remark, okay? Okay, and then they actually stopped trading for a while and said, wait, let's figure out what's going on. They say they're not going bankrupt. And they then publicized that, yes, we're not going bankrupt. And then when they opened the trading again, the price went back up. But what's the interesting point? Suppose you could own a lot of put options on United Airlines. And you could have put up that web link. Okay? Think about what a put option is. You're waiting for the price to go down, right? Okay? You have, in some sense, incentive to cause mischief for that company, to make the prices go down. Does that make sense? So one thing that they're doing now an investigation of how did that link get onto the news. It would not surprise me if it was by somebody who had a financial interest in seeing the price of that airline drop. It could have been a mistake, or it could have been a deliberate mistake. Okay? And you see how owning put options gives you the ability to profit from such deliberate mistakes. Any questions about that? You also have the more likely and more usually have the opportunity to profit from being right that it will go down. Or, more than that, protecting you in case you're afraid it's going to go down. That's probably the bigger use of these options. Any questions? So what is the payoff on a call? Okay? A call, when I buy a call, okay, at a strike price of K, okay, I have the ability to buy it at K, and if the current price is spot price is S minus K is what I would get if the price was if the spot price is greater than my strike price. If the spot price is less than the strike price, I wouldn't bother to use my option, and my payoff is zero. In fact, maybe it's easier to see in a picture. When you have an option, when you have a call option, okay, if I have the strike-up price is $50. If the spot price is greater than it, if I execute that option, my profit is the difference between the current price and my strike price. Okay? Does that make sense? Because if I can sell the price to stock to somebody else at $60, and I can buy it from you for $50, I can clear the difference here. So the value of my option increases linearly with stock price past the strike price, and is zero otherwise. Okay? So if I own a call, this is my payoff function. Okay? On the other hand, if I wrote a call, okay, if I sold somebody a call, okay, then my payoff is the opposite, the inverse of them by a conservation of money argument. Okay? If you agreed to sell me the stock for $50. You are out the complimentary amount of money for that. Any question about it? So the payoff function, if you write a call, is that it will cost you nothing so long as the stock price stays below the strike price. But when the price gets above it, it will cost you money to have written a call. Any questions? So my return on, if I write a call, what is my return? Can my return ever be positive? If I sell you, if I give you a call, right? You will get this kind of a payoff function. My payoff function will be like this. Can I ever make any kind of a profit on that? Yes? How would yes be?
Price of the option.
The price of the option, that's what's not factored in here. If I give you a call option, you should certainly take it as a gift. Does everybody agree with that? If I'm giving you the option to buy Microsoft is now what? At, let's say, $50 a share. Suppose I give you an option to buy Microsoft at $500 a share a year from now. You should say thank you. Okay? Because that call option can never have negative value. Right? Now the difference though is people don't give options in the world. They sell them. Does that make sense? So the issue is not, the question is, yes, there is a negative payoff function here. But what I need to decide is, if I want to sell call options, okay, I've got to figure out how much should I sell it for in order to justify taking on this kind of risk. Does everybody see that? So that is where the problem of option pricing comes in. Okay, there is a rational reason for people to sell call options. Okay? But that's only if the price they get will be high enough. Any questions? We also talk about put options. Put options are an agreement, a guarantee that you can sell the option at a particular price. Okay? Sometime in the future. So if in fact, the current price is the price that on the market is S, but you have agreed to guaranteed me that I could sell it for K. So long as I can sell it for more than it costs currently on the market, I am ahead. Otherwise, it is neutral. So if we look at the payoff problem on a put option, if I own a put option, if the price goes below the strike value, okay, then my put option has money, has value. Because I can buy this thing for 20 and sell it to you at 50, I am guaranteed a profit of 30. Right? If in fact you're telling me that I am allowed to sell it to you for 50, but I don't have to. If the price is $60, okay, I am not going to sell it to you at 50 because it's an option, right? Does everybody see that this is the payoff function for a put option? Any question? So if I own a put option, I get that payoff function. If I write the put option or sell it, I have the complementary payoff function. Okay? Again, always negative. Okay? But I only make this, I will only go through this process of doing it if there is enough in the way of fees for it. If my expected gain is great, if the gain is worth the risk. Okay? Any questions? So if you are a seller of options, maybe I'll go up here. Actually, I think I have it. If you are a seller of options, you are getting small bits of money at the beginning Okay? Every time you sell an option, you're getting a guaranteed payment stream. And hoping that your losses will be less than that. Okay? Potentially your losses might be very large. Okay? But you want to price it so that it's worth taking the risk. Somehow there is a price where it is worth somebody taking that risk. Okay? And calculating that thing has to do with options pricing. So next class we're going to start to talk, any questions about that? Next class we're going to talk more about options and how they work and how they are priced and what the values of them should be. And how do you use them? That's going to be the other issue. Okay, thanks for your attention, and I'll talk to you guys next class.